Good morning, this is Michael with Back to the Future Trading, and we are continuing to track the E-mini S&P spring pattern back from my field trip with my son in his class, and was super excited to see the forecast play out over the levels that we said we would see reactions at, and continuing to see the pattern form is super exciting. The fact that we're able to sort of track what the banks are planning to do, and we're sort of one step ahead of them, has enabled many of you to, from the emails you've written to me and the feedback I've gotten, lock in a lot of points. So I'm excited that you were able to utilize that analysis to stay ahead of these moves. We've come into the phase one that I talked about in the video last time, and I just want to review with you real quick. I'm going to take this rectangle, I'm going to move it off to the side for a second here, and just sort of clean up this chart that we've been using as a template. And these gray lines were the lines that we were using to sort of predict where the market was going, and we've already passed through them. The orange bars were the directions that we were anticipating the market to go, and we've been following that direction pretty closely. But we're at currently a critical point in the pattern. Let me show you what I mean by that. So the phase one occurred on this bar a couple days back. We talked about that. We knew it was coming. And I want you to see the formation of the pattern in relation. We'll call this phase one current. Phase one current. And now over here last year, I'll move where it says stop run away. I'll move this circle away. I'm actually going to pull that rectangle back. And I'll pull this line away. Just clear it up a little bit so we can see. And this was phase one in 2016, back in May of 2016. Now it's April. So we're off by about 3 weeks. Phase one, 2016. And I want you to allow your eye to start to, let me pull some of these orange lines away. I want your eye to sort of see what's happening in the pattern. That is to say, we have the high candle here, the down candle, then we have this huge wick, right? It came all the way down and all the way back up. Okay, and then the day before that we had this wick with the huge drop down. Then we had the stop run all the way up, and the market came all the way down, and many of you took advantage of that. And now this morning, we are sort of right here at 49.50, that magic number. So there's been a really big volatile swing back and forth between the high and the low. Well, if you look at 2016, you'll see that the volatility was expected sort of between here and here. You see those large, big, rangy, wicky candles? And then where the phase one was, you had this huge drop down, and then this huge volatility up, and then the pull all the way back down, and then sort of count out the days with me. Ready? Phase 1 is 1. Then you have the next day, 2. Then you have the third trading day, 3. Then you have this fourth trading day with the spinning top pattern here, 4. And then the fifth day, that's the bottom day. That's where the poop hits the fan day, before the phase 2 kicks in. And so over here on the right hand side, again, we're looking for patterns, for clues of the pattern that the bank is following. They don't want us to know that this is even something that's possible. So phase 1 was the 1, and you have 2, and you have 3. Today is day 4, and then Friday is day 5. So in the sequence of events, we're a day and a half away from looking for the push that's going to take us, hopefully, if this pattern plays out, back up into the new highs. So what I drew over here is kind of shifted to the left now. All right, the way the number of days are working out, this double bottom pattern, this second stop run, should be set to occur by Friday. Now today is April 6th, 2017. And so we're talking about the behavior of April 7th being day 5. So this tends to be, based on this analysis, the point where things start to get really interesting for us. Meaning, if this market's going to continue higher, the banks want everybody to think that it's going to drop lower. And day 5 last year was a plunge candle. Think of it like a base jumper, or someone who jumps out of an airplane, right? And then they hit a rubber pad and they bounce all the way back up. So the market opened a year ago at 2014, came all the way down to 1998, so $16. Actually, it fell even farther than that. It opened, forgive me, at 2018, 2019, and came all the way down to basically 98. So it fell $21, but then it finished almost back where it started. So when I say plunge candle, I'm describing a situation or a circumstance where the people who manipulate and bully this market essentially wanted people to believe that a critical level had been breached. In this case, it was 2006. And you see there's that double test of that area. They come after that area and they want people to believe that the stop is run, that weakness has taken over and we're going to drop forever. And this causes panic. A herd theory describes people all doing the same thing because nobody wants to be different or contrarian. And so the herd theory here enables the banks to convince people, once that level's breached a third time, hold on to the handrails because we're going to fall forever. And what ends up happening is that all the retail traders sell to the banks at wholesale prices. They get all the liquidity they want, and then that gets them the impetus they need, the momentum they need to reverse and take things higher. So I want you to think about that herd theory as we come into that area of time over here in our current setup. Let's take a look at that. So if we look at the two patterns for comparison, here are some food for thoughts right here. Today is number 4. And so in relation to where we've been, number 4 has a lower low. So if you look at the 2016 pattern, number 4 was a lower low, and then a volatile day where it finishes where it started. So if we look over here to the left, in 2017, day 4 is a lower low, so they punch that stop. And if we follow the geometry of 2016, the low or the high of day 4 is below the high to the left, which means here is the high of the day to the left. So day 4 has the volatility. It doesn't come all the way up structurally. We see that it finishes proportionally sort of somewhere up in here, which is 2364 area. So today should close lower than the open and have a very high volatile wick above us where we come all the way up and then finish all the way back down lower than 345. The big plunge day is tomorrow if they follow the sequence, because they come back and they take out the low of day 4 on day 5 and they drop it down. And so I'm looking tomorrow for fuel that they would use to drive that. And I'm going to go on forexfactory.com and I'll see that tomorrow at 8:30 there's an unemployment claim. And that's the only one. So only one report tomorrow at 8:30, and that might be the fuel they need to drive the breach of the low at 2337 before the phase 2 comes here up into the future. So there are 2 areas that they were going to punch the stops of. One was here, which they've done right on time. The second one is the more interesting one, because on day 5 they broke in 2016 the low of the prior stop run of the phase 4. For them to do that, they would need to come all the way down to 2317.5 by day 5, which is pretty ridiculous. Conservatively, if they came and just triggered these lows, it would be 2332 by tomorrow. Let's go back and take a look at 2015 really quickly. If I can find that. I think it's on another chart. Hold on. So over here in 2015, I want you to see the same pattern and see if you don't smell the same stuff I smell here with your sniffers. 1, 2, 3, 4, 5, 6, and then 7 is the phase 2. This one appears to be in 2015, lining up more closely to the structure of what's taking place in 2017. So if I just stretch this out, do you see how there's 2 tests here at the double bottom? We have the bottom from the phase 4, which was already put in, and I'll come over here on the left and duplicate that on the right. The bottom from the phase 4, the pullback, the fake out, and then a drop back down into this second ABC pattern. They never break the low of the phase 4. And so far here, that looks like what we're starting to see replicated. An intermediate high and then a pullback down into another series of plunge candles that drop and go fishing for weakness And then again, by the phase 2, we start to launch towards the new high. Phase 2 on this is 5 days from now, so that including today would be Thursday, Friday, Saturday, Sunday, Thursday, Friday, Saturday, Sunday, Monday into Tuesday is when we're looking for that huge launch back up of that blue candle. So again, if you look at the structure, day 4 is very similar to day 4 of 2016. It's a stop run day where the candle opens and closes lower, comes all the way down and goes all the way back up. So we've already had the stop run for the phase 4. It's starting to make its ascension back up and will close, generally speaking, 2 years in a row lower than the open. So we expect to see it below 23.45 half if they follow that same pattern. And then day 5 has that similar pull back down and then launch back up. Day 6, which would be Monday, I think, of next week, pull back down, plunge back up. And so these support levels then become critical, 23.41 and 23.32.25. So playing out really quite nicely, day 4 into day 5. Let's see if that pattern continues. Check it out on the 60-minute time frame. Stand by. So using our traditional methods of analyses on these markets, I'm starting to see inversions, and that historically happens near trend reversals. I'll put a link to it in the description. There's a guide to these histograms that we follow called a Hitchhiker's Guide to the Histograms, and there are patterns that we look for, and things tend to flip when we see those patterns. Green dots behave like red dots behave like green dots. And when I fill those patterns in, pattern 4 and pattern 5 from the book that you can check out in a second, you'll see that we're seeing these pattern 4s and pattern 5s occurring at a very distinct point in the range. And that tells me where the banks are setting their traps up, because they should be buying where they're selling, and they should be selling when they're buying. You notice the first one right here? The first one came right at that low, and then the second one came right at this low right here. At a point where we were expecting selling, both times the banks opted not to sell and instead purchased. And at a point where we were expecting buying, the banks opted not to buy and they sold up here. So tremendous resistance at 23.75 and tremendous support at 23.40 again as of this morning. The banks had the option to purchase between 5 a.m. and 6 a.m. Eastern this morning, and so far they're exercising that right to purchase. Okay, but I want you to be aware of one thing. When the trend is doing this, when we're seeing these backward moves, many times you'll see a reversal. So instead of the market going up at 6 o'clock, it'll tend to go down. And this is also a pattern 5 from your histogram book. It's the highest of the high candles to the left, green dot. So this 6 a.m. candle gets 2 of these red dots right here, or red arrows, straight out of that histogram guide, which again is in the description of this video. The next place we see a red dot is 12 p.m. Eastern Daylight Time and 1 p.m. Eastern Daylight Time. And in almost all of the cases so far, when we arrived at the selling pressure time, the banks reversed and went in the other direction. So of all the places that we see a red dot on this chart, at the close of the candle, I want you to see what happens so far. with the exception of this. Fill it in. All of the other candles produced an up move when they had time to the next green dot. This one was right next to this buying pressure dot. This one was right next to the buying pressure dot. And so when we get to 12 and 1 o'clock today, whatever surge is going to occur is most likely going to happen there. And the stop that they're looking to take out, again, is down here at 23.38. They're just causing more and more panic. It's like waterboarding with price action. So my gut right now, based on what I'm seeing here, almost every one of the red dots is producing a buying pressure signal, and almost every one of the green dots, when we arrive at that time, is producing either a stagnation in the rise of the price or an all-out push down. So if we're to see that same kind of behavior pattern extend, notice this green dot produces sideways stagnation. This green dot produces sideways stagnation and then a drop. And we're already starting to see that flag pattern kind of form here. So I'll try to get this video out quick so you can follow along and watch what's happening. We, of course, have the ability to go down to the lower time frames, 10 minute, 5 minute, 3 minute, even the 1 minute, and see those trend pushes down in real time. And if you have the software, it's a real handy feature to be able to use that, because down on the smaller time frames, we can catch some really precise entries, almost to the minute, sometimes to the second, and catch the banks when they're about to push. So pretty nice outlook here for this morning. Again, in keeping with my earlier admonitions, we now know the size of that range. It's about there. Middle of the line is 23.57 half. That's a place where you're going to see resistance today. In between those 2 points is 23.49, essentially, which is where we're hitting it. And then if you cut that next area in half again, we're looking at 23.66. So these are all places to look for bounces for support and for resistance when you arrive at these critical times. If you have the software, again, you know if you're looking for resistance or support. And so keep your eyes open, follow those teachings that I've given you in the classes as a customer. I really appreciate your time. I'm excited to be following the daily bar analyses here with you. We have some really great classes, some really great students, and so if this is the kind of analysis forward-looking that you're hoping you would find, we're out there, we're here, and we'd love for you to join us. Do me a favor, take part in the discussion by visiting us at our website, backtothefuturetrading.com. When you get there, you'll see a place called View Demo in the upper right-hand corner, or labeled rather, View Demo. And that gives you an opportunity to come into this area where we've prepared some training videos to show you some of the things that we're doing intraday to help you research better positions and better timed positions in the futures, forex, or equities trades that you're taking every day. We also have a webinar this afternoon. I'll put a link to that in the description as well, if you'd like to learn more about what we do and how we were able to predict moves in the markets yesterday and today for our intraday trading community. Take care, everyone. The market you trade is not random. We're more than happy to show you how that works here at backtothefuturetrading.com.